I want you to imagine waking up tomorrow and discovering that the entire U.S. housing market has quietly frozen solid overnight. No dramatic price crash like 2008. No screaming headlines about foreclosures, just a silent paralysis where nothing moves, nobody buys, nobody sells, and the few homes that do change hands come with deals so sweet, you'll kick yourself for waiting. That's exactly what the CEO of America's biggest homebuilder, D.R. Horton, just admitted on their latest earnings call. And the numbers buried in their financials prove this isn't hype. It's happening right now under everyone's nose. Hit that subscribe button and drop your zip code in the comments because by the end of this video, you're going to know exactly how to turn this frozen market into thousands of dollars in your pocket, whether you're buying, selling, investing, or just renting. So let's dive straight in. Paul Romanowski, the CEO, didn't mince words. He said incentives are way up, and that's why they're guiding gross margins lower, which in plain English means the largest home builder in the country is willingly slashing their own profits just to get people to sign contracts. Their quarterly revenue slipped over 3% to $9.7 billion. Full-year revenue dropped almost 7% to $34.25 billion, yet closings only dipped 1% to 23,368 homes, so they're moving almost the same number of houses but making dramatically less money on every single one. That's not a company riding high on booming demand. That's a company throwing everything at the wall to keep sales from falling off a cliff. And they're not alone. 38% of builders nationwide slashed prices in July alone, up sharply from 29% back in April. But here's the twist everyone keeps missing. Prices aren't crashing, they're just going sideways. And sideways in a high-rate environment is the most dangerous scenario imaginable because it creates a perfect storm of low demand, shrinking supply, and desperate builders who are about to hand you concessions most people haven't seen in 15 years.
Moody's chief economist Mark Zandi just raised his housing warning from yellow to full-on red, saying home sales, new construction, and even prices themselves are headed for a slump unless mortgage rates drop meaningfully from today's near 7% levels. And guess what? The Fed's own minutes show they're in no rush to cut aggressively. Housing starts and building permits have already fallen to levels we typically only see in recessions. Yet completed homes keep rising because builders are finishing projects they started 2 years ago when rates were half what they are now. But they're refusing to break ground on anything new. Translation, inventory of finished homes is piling up, while the pipeline for future supply is drying up faster than anyone wants to admit. Total monthly cost of owning a median home is pushing $4,000 when you factor in skyrocketing insurance, property taxes up 18% year over year, and mortgage payments at current rates, compared to just $2,296 to rent the exact same single-family house, a 40% savings that's making millions of would-be buyers say, why bother owning at all? And then there's the golden handcuff effect that's strangling the resale market. Over 80% of existing homeowners have mortgages at least 1 full percentage point below current rates, many locked in at 3% or lower. So selling means trading a cheap payment for an expensive one, which means they simply won't list their homes no matter how badly they want to move, creating the lowest level of existing home inventory since the 1990s, even as new home inventory climbs. This isn't 2008, where oversupply and bad loans forced a price collapse. This is a supply freeze combined with affordability collapse. And that's why prices refuse to drop more than a few percent in most markets, even though sales have slowed to a crawl. Builders are feeling the squeeze so hard that they're offering rate buy-downs that knock a full 2 points off your interest rate,
covering tens of thousands in closing costs, throwing in free upgrades, blinds, refrigerators, even landscaping packages. Anything to avoid carrying unsold spec homes into the slower winter months. Unlike the last crash, these companies are sitting on fortress balance sheets with billions in cash, so these concessions aren't fire sale desperation, they're calculated moves to protect shareholder value. And that means the deals are real, they're sustainable, and they're only going to be around for the next few months before builders pull back and wait for lower rates that may never come. If you're a buyer sitting on the sidelines waiting for some mythical 20 or 30% price crash, you're going to be waiting forever because the low-rate lock-in plus regulatory costs that now account for 25% of the price of a new home, plus tariffs adding another $9,000 per house, mean prices have a floor that simply didn't exist in the last cycle. Your opportunity isn't a price crash, it's builder desperation right now. Walk into a D.R. Horton community, a Lennar community, a Pulte community, any of the big public builders. Tell them you're getting quotes from 3 competitors, and watch how fast they start stacking concessions because their CEOs are on quarterly earnings calls explaining to Wall Street why margins are shrinking, and the only acceptable answer is higher closings at any cost. If you're thinking about selling, understand that every quarter you delay, your negotiating power shrinks because buyer confidence is eroding and the spring selling season everyone keeps praying for simply isn't materializing. Builders themselves are admitting the usual January to June surge started weaker than anyone predicted. And when Moody says many are giving up on expensive rate buy-downs and delaying land purchases,
That's code for next year's inventory pipeline is getting shut off, which means fewer choices for buyers down the road and even less urgency to pay asking price. Investors need to pivot hard from betting on appreciation to locking in cash flow, because new construction slowing down translates directly into fewer rental units hitting the market 12 to 18 months from now, keeping occupancy high and rents firm even in markets where sale prices flatten. Smaller private builders who expanded aggressively when money was cheap are suddenly facing labor shortages, material price spikes, and carrying costs on half-finished subdivisions, creating distressed opportunities for cash-rich buyers to scoop up lots or entire projects at steep discounts from motivated sellers who can't finish what they started. Renters, your relief is coming, but it's on a lag. New supply takes time to deliver, so negotiate with your current landlord now. Ask for a free month or reduced renewal increase because the data shows single-family rents are already softening in oversupplied Sunbelt markets, but widespread relief probably doesn't hit until late 2026 or early 2027. Location still trumps everything. Texas and Florida actually look decent because permissive zoning kept construction humming and prices more reasonable than the national average. Cities like San Antonio, Houston, Jacksonville, and Orlando are seeing actual price declines in certain zip codes, while inventory sits longer than it has in years. The Midwest and stable parts of the Northeast never saw the crazy run-up the coasts did, so price growth there is moderate and downside risk is lower. But if you own in former hotspots like Phoenix, Austin, or Boise that doubled in value during the pandemic, get ready for appreciation to grind to under 2% next year as move-up buyers stay locked in and new inventory finally catches up with demand. Every leading indicator, permits, starts, completions, is flashing red, and history shows when housing construction rolls over this hard, residential construction jobs start disappearing 6 to 9 months before the broader economy tips into recession.
So the ripple effects are just beginning. Bottom line, after poring over earnings transcripts, Fed reports, and local MLS data for weeks, the collapse isn't in sticker prices. It's in transaction volume, builder profitability, and household confidence. And that exact combination is handing savvy people the best buyer's market for new homes we've seen since the Great Recession without the systemic risk that made everything scary back then. If I was buying right now, I'd be touring model homes every weekend, pitting builders against each other, and locking in a rate buy-down that saves me $60,000 in interest over the first 5 years alone. If I needed to sell, I'd price aggressively today because waiting for some fantasy rally that never comes just burns equity and carrying costs. If I was investing, I'd be hunting cash-flowing rentals in paths of progress where permits are plummeting, and if I was renting, I'd be renegotiating my lease with data showing vacancy creeping up. The market isn't crashing, it's seizing, and the difference is millions of dollars for those who move before everyone else figures it out. Smash the like button if you're as shocked as I was that the CEO basically admitted they're bleeding margins just to keep the machine turning. Turn on notifications because next week I'm dropping a full breakdown of the specific zip codes where inventory is exploding and price cuts are deepest. And most importantly, tell me in the comments what you're seeing on the ground. Are builders in your area throwing in free appliances? Are open houses empty? Are sellers finally dropping asking prices? Give me your city or zip code because real-time intel from all of you is how we stay ahead of the curve together. The housing market has entered a phase nobody has a playbook for, but the winners will be the ones who stop waiting for yesterday's crash and start negotiating today's deals. So subscribe, share this with anyone even thinking about real estate, and let's keep exposing the truth the mainstream won't touch. See you in the next one.